Well, good morning, everybody, and welcome to this year's IFS Green Budget. I'm Paul Johnson, Director of the IFS, and it's my pleasure to welcome you to this, the first virtual IFS Green Budget, though the second in a row where we've been producing a Green Budget and the government has very rudely abolished the budget whilst we've been in the process of putting together our Green Budget. Nevertheless, everything I think we have to say here will still be relevant when the government, the Chancellor, finally comes to produce his budget, we presume now in March of this year, as we look at the public finances and macroeconomic situation. Most of the big issues, whilst there's a huge amount of uncertainty around them, will remain as they are now in broad terms. So today we will be looking specifically at the macroeconomic issues, which Christian Schulz and Ben Navarro of Citi will be talking about, and the public finance issues, which Isabel Stockton and Carl Emerson, my colleagues at the IFS, will be talking about. But we have also produced, as part of this Green Budget, other pieces of work which we've put out before and which are available on the IFS website. One piece on the spending review, which we are still expecting to happen this autumn. One piece on the levelling up agenda, which clearly remains at the centre of what this government is thinking about, and another piece on how benefits ought to be or might be changed as we go into next year, following the quite substantial, supposedly temporary increases in their generosity. All of those pieces can be found on the IFS website. All of them have already received quite a lot of coverage in the media, as today's event has done. We have until 11:30, and the way things are going to work is we're going to have two brief introductions, one from Tim Garden, who is Chief Executive of the Nuffield Foundation, who we're extremely grateful to for having helped fund this year's Green Budget once again. So Tim will say a few words of introduction. And then Andrew Pitt, who is Global Head of Research at Citi, with whom we're delighted to be collaborating again this year, will be saying a few words. He'll then hand over to his colleagues, Christian and Ben, who'll be talking about the macroeconomic situation, Christian looking globally and Ben looking more at the situation in the UK. And then, as I said, Isabel and Carl looking at the public finances. If you want to ask questions, you should have a link to the Slido app. Do put your questions in there, and also vote for other people's questions so we can see which ones are the most popular. And once Christian, Ben, Isabel and Carl have finished speaking, we will go to questions and we'll carry on until 11:30. So thank you very much for your attention. I will stop there and hand over briefly to Tim.
Well, thanks very much indeed, and good morning, everyone. The Institute for Fiscal Studies is the Nuffield Foundation's single biggest grant holder, and the Green Budget is one of the main cornerstones of that portfolio. And we've been supporting the Green Budget now for 7 years, and from out of its work and the implications of that work have come some of the major IFS projects that are central to Nuffield's wider purpose, from the IFS Annual Review of Education Spending to our most ambitious project of all, the Deaton Review on the nature of inequalities in the 21st century. Now, the Green Budget, of course, was conceived as a device to offer an independent check on the Chancellor's annual ritual to keep the figures straight and the narrative clear. And so great has its authority become that the fact that the budget itself is not taking place is, as Paul has said, quite immaterial. But it's odd to recall Paul last year, just before a general election, setting out at this same event how narrow would be any government's room for fiscal manoeuvre. Well, whatever was fiscal prudence then has become something unimaginable 12 months later. And the Green Budget's task can never have been more difficult, as the terrain has changed shape week by week, as the state has found itself intervening to an extent no government can have imagined in our lifetimes. And that's without the economic uncertainties of Brexit. And as Paul said, you'll have seen key chapters of the Green Budget being released over recent weeks. And one might have supposed it would have all been overshadowed by the pandemic, but to the contrary, the sheer range of the work has become an essential guide that we need to understand the sheer scale of the economic challenge and rethinking necessary in COVID's aftermath. In fact, in the course of 2020, Nuffield has been proud to have funded some of the IFS's most prominent work on the wider implications of COVID, from Lucinda Platt's analysis of the disproportionate effects of the crisis on ethnic minority communities, emerging out of the Deaton Review, to Sarah Catan's work on the effects on families and child development, and Martin O'Connell's on food security. But all these, in a way, are just aspects of the acute central questions surrounding the strains on the public finances that the Green Budget considers today. So, regardless of the fact that Rishi Sunak's red box is locked away for now in some cupboard in the Treasury, the IFS analysis has never been more necessary, and its down-to-earth clarity of its messages never more sobering. When there seems to be very little in the way of a map to chart the road ahead, there's never been a more urgent need for the sort of coherent, holistic account that is the Green Budget's trademark. And I suppose it says something of the extremities of this time. The questions of future tax revenues are a topic best left for next year. There's plenty to talk about, and I'm very glad that Nuffield has again helped to make all this possible. And so now let me hand over to Andrew Pitts, Global Head of Research at Citi.
Tim, thank you very much, and good morning, everybody. Yes, Tim mentioned I'm Andrew Pitt. I'm Head of Research at Citi, and we're delighted to be collaborating again with the IFS on the production of this year's Green Budget. This is our third year of collaboration with the IFS, but I hope it's the third year of many more to come in the future. A year ago, we were launching the 2019 Green Budget into a packed room at Senate House, and I think it's probably the understatement of the year to say how things have changed. Obviously, our lives and the UK economy have upended by the coronavirus pandemic. And as Paul mentioned at the start, obviously, this is a Green Budget, in fact, the second year of a row with a Green Budget without a budget, although obviously there is a budget in waiting coming in the spring of next year. But I think particularly this, this year and everything that's happened this year, and also the impending challenges we're going to get from a final Brexit that comes in 2.5 months, I think mean that the high quality insights that are produced by the IFS are never more needed by policy makers and by corporate leaders around the world. And so it's really great for us in that sense to be collaborating with our insights that we can bring to the great work of the IFS. Again, what we've done this year is we've added 3 chapters to the Green Budget. Our aim is to complement the work of the IFS. So what we've attempted to do is add a global and a macroeconomic perspective and add a series of forecasts for the global and the UK economy. Obviously, you're going to hear from my 2 colleagues, Christian Schultz and Ben Navarro, in a moment. Just very briefly, what we've tried to do this year is put a first chapter in looking at the global economic outlook. Our second chapter delves much more deeply into the UK and frankly paints a very challenging picture for policymakers in the UK. Our own forecasts are frankly pretty subdued at the moment, and we don't actually expect UK output to recover to late 2019 levels until some point in the first part of 2023. Our most optimistic scenario would see that brought forward by about 12 months to probably the second quarter of 2022. But as you'll see from our commentary this year, there are so many pathway uncertainties around both what happens with the virus and also what happens with the eventual Brexit that we get. And obviously, at the moment, we have very little clarity on that. And that's why what we've tried to do in the third chapter this year is dig a little bit more deeply into what the Brexit shocks could be. And obviously, one of the biggest challenges is, and then there's a quite unfortunate symmetry in this, that the sectors of the economy that are most likely to be impacted by a challenging Brexit are actually quite different to those that are most impacted by COVID-19. And so there's a danger as we go into next year that there will be another series of costs borne by the UK economy, hopefully, as we're coming out of the worst of the pandemic. So that's how we've attempted to support the IFS this year. I'd just like to thank my colleagues Christian and Ben for their great work and great partnership with Paul and Carl and Isabel and the team in combining the document this year. I'd like to sort of close by thanking the IFS for the opportunity to collaborate with the Green Budget over the last 3 years. And just actually to the previous speaker, to Tim, I'd actually like to say a great thank you for myself as sort of leader of a large research organisation. It's great in the UK how strongly the Nuffield Foundation does support high quality independent analysis, obviously how important it is for the IFS, but other projects beyond that. So Tim, thank you very much from me and all of the team at Citi So let's all try and stay optimistic amid the gloom. Let's see how we test that sentiment by 11:30 this morning. But thank you again for the collaboration, and I'll now hand over to Christian Schulz from Citi's economics team.
Thank you very much, Andrew. I'm going to now share my screen. And start talking about the global economy. A year ago, when I was presenting, the big topics at the global level were what we, I think, at the time called the trinity of risks: global risks, US trade wars, Brexit, which at the time we didn't know whether it would happen at all, and certainly not in what shape and when, as well as the rebalancing in China, which had been depressing global trade. So it was really a big focus on trade, international trade, which had been in recession at the time and made us a bit skeptical for the outlook for the rest of the world. Perhaps the UK a bit more shielded from that than perhaps other economies. And in the UK chapter, if you may recall, we were debating the prospects of the economy under either a Conservative government after the election or a Labour one. And obviously Brexit playing a big role in that as well. How things have changed, as all the previous speakers have already mentioned, we now have a pandemic which has had nearly 40 million infections globally and many more unknowns, of course, and sadly more than 1 million deaths already. So what we're trying in the Global Outlook chapter is to, as far as that's possible, draw some lessons from the pandemic so far, both in terms of the health response, in terms of the fiscal and other policy responses, the political consequences, which will become clear in a few weeks, starting with the US election, of course, and then our forecasts themselves for the global economy going forward. So that's what I'm going to briefly talk through. And then, as said before, we're going to then move on to the UK economic outlook, which Ben's going to present. In terms of the pandemic and the lessons from it, what we attempted to do, because obviously this pandemic is still ongoing, and the way it will evolve and the policy response to it will have a big impact on our economic forecasts, we tried to look at how much countries were ready for it or not ready for it, and how they've responded and to what outcome. And we kind of tried to rank them, and the ranking is the order in which you see this slide. So starting with Germany, which on our ranking comes out on top, and Spain, which comes out at the bottom. So we look at 4 aspects here: the outcome itself, obviously, how many confirmed cases, and there's a second criterion, which I'm not showing here just to not overburden the slide, which is how many people lost their lives in it. And in that, in the G7 plus Spain, Japan performed best, and the US so far performed worst. Again, this is obviously subject to change as the second wave is currently rolling through Europe. Europe is obviously losing, some of the earlier gains at the moment, but we don't know how this will continue in the future. A second ranking is in terms of healthcare resources. Again, we looked at 2 criteria, not to overcomplicate, but at the same time to have a little bit of breadth in the ranking. One is healthcare spending as a percentage of GDP going into this crisis, where the US spends the most ahead of Germany, and where the UK and Spain come at the bottom in this group of 8 large economies. And then we also looked at the number of intensive care unit beds in these countries, and relative to the population size. And overall, as I said, the ranking puts the US in terms of resources, or starting point, if you like, top, and the UK at the bottom. Obviously, the resources had to be put to good use, and there it looks quite different. So we looked at the lockdown stringency, and we looked at the amount of testing per positive case so far, and there the ranking is different, in particular in the US, where despite huge resources, the policy effort actually fell short. They come bottom there. Japan comes top there. That's mainly because they tested quite a lot for relatively few positive cases. And then the last one, and that's a bit forward-looking as well, is people's trust in the government's handling of the virus, as well as the second criterion again, which is how fearful people are of catching the virus. And there, the Germans and Canada come out on top. So irrespective of the resources and the policy effort and the outcome, it seems that Canada and Germany did relatively well. Of course, they both obviously had a relatively good health outcome so far. But with Japan, you can already see that even a relatively good health outcome does not guarantee voter satisfaction. And at the bottom, also, you've got the US. So as I said, this is looking at the lessons from the crisis in terms of the response of health ministries, the outcome itself, the resources that were available and which have been obviously augmented throughout the crisis, the policy effort to contain it, which is ongoing, and the satisfaction of voters or the trust of voters in their government. These factors, we believe, are also going to have an impact going forward, or where countries have underperformed so far, they may look to those countries which have outperformed in order to learn the lesson from them. But health ministers are, and health ministries are only one part of the policy response overall. Just as important, especially going forward, are going to be the finance ministries, the finance ministers. And at the start of the pandemic, we defined an optimal policy response for economic policymakers, and that was support in 3 waves. The first and perhaps most important one is the fiscal absorption of private sector losses, with people losing their jobs, with companies not being able to operate because they're forced to or they can't because of these lockdown measures. They would be, in the absence of fiscal support, accumulating debt, bank debt, which would be very expensive without any support from the government, and would lead to very deteriorated, very impacted balance sheets, which then, once the crisis is over, would lead to years and years and years of balance sheet repair, little investment, little spending, and therefore make the recession deeper and especially much longer. So absorbing those losses, for instance, with furlough schemes, with grants to businesses, with loan guarantees, with direct loans to businesses, were the crucial part of the initial response. And we've seen, especially these furlough schemes or unemployment benefit schemes in various countries in the world, being beefed up, being much more generous than what we'd seen before, especially in the Anglo-Saxon countries, in the UK and the US, where so far unemployment benefits had been relatively low. In the US, of course, the most extreme variant with these $600 per week payments, which were calibrated in a way that the mean worker, the average worker, would get 100% income replacement, as you can see in the chart on the left-hand side, which means that the median worker, and therefore most workers, actually got replacement rates well above 100%, which means they earned more being unemployed than they previously had in their employment. That obviously is very good for spending going forward, because these households saved a lot of money and are now going to spend it. And that drives our relatively optimistic US forecast, as you'll see in a minute. Then there is a second wave. Part of the first wave, I should say, is that central banks make sure that governments can borrow at very low rates. So they buy up the debt, the issuance with their QE programs, and they keep interest rates extremely low and guarantee that this will happen for a long time. So creating fiscal space was a very important part of, by the central banks, was a very important part of this first wave as well. Then comes the second wave. So once the virus is under control and supply comes back online, there's a big risk, and we're seeing that at the moment, that demand doesn't quite follow as quickly. So there's a gap between supply and demand. And in order to close that as quickly as possible, a second wave of fiscal support, more conventional fiscal stimulus, is necessary. And then, of course, in the long run, there may well be structural changes in the economy as economies reconfigure, as demand changes, whether tourism happens in the same way as before, whether people work in the same places, or whether the same technologies prevail. And there will be winners and losers to that. So in that sense, it's very important for economies to maintain a high degree of flexibility in order to facilitate that adjustment. But there's also going to have to be fiscal support to smooth the adjustment, for instance, in the form of active labor market policies, investment into education, into public transportation, and so on and so forth. So that's the third wave of fiscal support. And the numbers have been impressive around the world. The first wave support has been particularly strong in the UK and the US, in part because, as I mentioned before, previously we didn't have as much support in these, as much automatic stabilization as before, but also across the rest of the world. In terms of the second wave, obviously we've had some attempts in the UK and Germany, for instance, also Norway, to stimulate demand, but that's obviously now paused as the second wave of cases has put paid to hopes that supply would come back online completely very quickly. And then in terms of third wave support, the main event, fiscal event around the world that we see so far is the EU's recovery fund, 750 billion to be spent over the next 3 to 4 years, which countries like Italy and Spain will benefit massively from. So there's going to be huge support from that. It's not just policy which changes. We also see big political consequences. So there's a chapter in chapter 1 talking about the political consequences of the virus. And when we say political consequences, we don't just mean changes in who's governing each country or what coalition emerges in the next election, although we do see some impact there as well. On the right-hand side, you see how leaders' popularity ratings have changed. So Mr. Trump and Mr. Johnson have lost popularity. Mrs. Merkel and Mr. Macron in Europe have gained popularity. And as I mentioned at the outset, the US election may be the first event post, middle of the virus event where this political change will come to fruition. But more important perhaps than who's running countries is what policies they will pursue. And there, I think there's 3 that I'd like to highlight. One is there's a big demand for protection from the government, whether that's on healthcare, whether that's on welfare. So the return of big government is, we think, something that will be sustained and will impact policies irrespective of who'll be running the economies. Then, very different from after 2008, 2009, banks play quite a different role this time. At the time, banks were seen as responsible for the crisis and were heavily regulated, and the connection between the government and the banks was seen as dangerous. Now, banks played a very important role in getting help quickly to businesses with these loan guarantee schemes, for instance. So banks play a very different role this time than they did last time. We think that will also be sustained. And then the question of monetary policy and fiscal policy cooperating to deliver support for the economy, which Ben, I think, at the end will also talk about. So these, we think, are big consequences of the crisis. Finally, our forecasts. Well, we think that the global economy is going to shrink by about 4% this year and then rebound by about 5% next year. It will take most countries beyond next year to get back to pre-crisis levels of output, with 2 big exceptions. I already mentioned the US, mainly because of these extremely generous support measures for incomes, household incomes, and the fact that they didn't have a, if you like, national lockdown, a lengthy lockdown like we had in Europe. The US economy seems to be shrinking less this year, near to 3% than 4%, and will also be growing strongly next year if there is another big fiscal package. So the US may reach pre-crisis levels of output already in early 2021. And the other is China, which, at least according to official data, managed to close the output gap or to return to pre-crisis levels of output already in the second quarter of this year. But for the rest, it's not looking good. It's going to take a long time. There will be output gaps for a long time. There will be fiscal support for a long time, and that's going to drive debt ratios up to levels not seen in a very, very long time. We see more charts on that, especially for the UK, but around the world, we see debt ratios in most European countries and the US well north of 100% of GDP. And these are levels which we traditionally tend to associate with Japan and the Japanification. So that, I think, will already give us a hint on the discussion going forward. I'll stop with this and hand over now to Ben for the UK economic outlook.
Thank you very much, Christian, and good morning all. Yes, so the UK, just in conjunction with the kind of global picture Christian described, the UK has been very hard hit by COVID-related lockdown restrictions in the first half of 2020. In fact, the impact in the UK has been particularly severe, with GDP having now been measured to fall by 19.8% in the second quarter of this year. There are three factors behind that relative underperformance. The first is a longer period of lockdown, especially in comparison to some other European economies. The second is the sectoral composition of the UK economy, with around 13% of UK output generated via sort of activity that depends on face-to-face interaction, compared to around 10% in the Euro area. And the third factor has been the specific accounting methodology used to measure public sector output in GDP, which in the UK has measured a sharp contraction in the second quarter, despite the very substantial increase in spending. Now, our long-held expectation, given that initial impact, was that there would be an initial sharp rebound in economic activity through the third quarter, but then a very slow, protracted and difficult recovery facing the UK thereafter, something of an interrupted V profile. And what we've seen so far is very much consistent with that. Over the summer, the UK has basked in a very strong rebound indeed, stronger even than our expectations at the start of the summer, with GDP growth first growing by 9.1% in June and then 6.4% in July. Three factors have underpinned this rebound. The first has clearly been the return of capacity as lockdown measures have been eased. So around just under 40% of the consumption basket was subject to restrictions in early April. That fell to under 2% in the latter part of July. And that recovery in capacity has then been realised first by households both bringing forward consumption as they began to spend more time at home or adjusted to that, but also some deferred expenditure effects as well, as they realised expenditures that they'd previously been forced to hold back. But third, and potentially most importantly, has been a very, very substantial degree of fiscal support that has been heavily concentrated in these initial months of the COVID crisis. So what you can see on the right-hand chart there is the monthly breakdown of discretionary fiscal measures over the course of this fiscal year, that's April 2020 through to March 21, that have been announced so far. And it's important to note, amongst all the kind of dramatic historical comparisons that Carl, Isabel and the IFS folks will discuss, that so much of that support has been very heavily concentrated over the summer in months that have now passed. Now, turning then to the second phase, from the rebound to then this slower recovery. We expect output to remain well short of normal levels, as Andrew described, well into 2023. In the near term, that primarily reflects the continued weighing effect of ongoing virus unease. As recent weeks have shown, the virus will remain a notable public health risk, we think, well into 2021. And we think that exerts a direct effect both on household sentiment and business sentiment as well. So that drives up precautionary saving first, but we also think that has an important reconfiguration effect in the sense that exposure to ongoing virus risk is highly asymmetrically distributed between sectors. And while that does drive some rotation in consumption, the kind of reallocation of things that aren't being spent on, so every pound that isn't spent, for example, in a restaurant in the UK, we don't think that's fully reflected in those areas that might see increased demand. Instead, we think some of it is saved. And we expect those effects to continue to weigh on output, as I say, well into 2021. Now, what's been notable in recent weeks is we've moved, is our assessment of the balance between this kind of the scale of the rebound, if you like, and the point at which this recovery this slower profile starts to materialize. And what was striking in, for example, the August GDP print is that level where you start to hit these demand effects and the profile starts to flatten out seems to be markedly lower than what we'd previously expected. As such, we think that output may remain in the final quarter of this year between 7 and 9% below the final quarter of 2019, which for historical comparison, during the financial crisis, peak to trough GDP fell by 5.9% on a quarterly basis. So this is a significantly larger economic hole than what we saw in 2008-9. Now, turning to the recovery and the drivers therein, we think households have an absolutely critical role to play in this recovery, much more than in a conventional business cycle. The reason is during the second quarter, the character of that fiscal support I referred to previously has been very heavily geared towards replacing household income in particular. And that has seen a huge increase in the household savings rate, which increased to an unprecedented 28.1% in the second quarter. But importantly, that level of support hasn't been kind of forthcoming for firms. Firms are still likely emerging from this crisis despite substantial support with impaired balance sheets. And with the outlook likely to remain very uncertain indeed, we expect firms to continue to prioritize building up cash buffers and maintaining cash buffers rather than investment. So we see businesses, and particularly business investment, as a lagging driver in the recovery rather than a leading one. Instead, as you can see, as I describe, households are really at the center here. And there we think there are broadly two plausible scenarios that the UK could follow. There's one where spending is resilient initially, demand is strong, and employment subsequently robust as well. And that can generate more virtuous feedback effects in the recovery, with household sentiment beginning to improve, precautionary savings falling, and a rapid rebound in output. Equally, a more vicious scenario is possible, in which uncertainty and precautionary effects weigh on spending initially, weigh on demand. That results in a deterioration in the labour market and subsequently feeds back into weaker sentiment and a weaker subsequent recovery. Now, as I've described, we expect demand to remain relatively weak, and sadly, we think the risks are very much tilted towards the latter, more vicious scenario rather than the more virtuous one. The particular challenge with COVID is that the impact usually falls disproportionately on sectors that use labour particularly intensively, and that's what you can see by the left-hand chart on that slide, with output falling much further among sectors that tend to have a lower level of output per worker on average. And that means that to the degree demand remains weak, that's likely to have a larger pass-through to the labour market and subsequently bringing these vicious feedback effects into play. So we currently expect unemployment to increase to around 8.5% in the first quarter of 2021. And that we think is likely to feed back into a subsequently weaker recovery. Now, clearly, as Christian described for the global outlook, so too for the UK, uncertainty is unusually large here and incredibly significant. We're also talking in the midst of a further or renewed resurgence in COVID cases, where precisely that ends is clearly outside our expertise and something that's incredibly difficult for anyone to speak to. So in conjunction with the IFS in this green budget, we complement our sort of central forecasts and scenarios and scenario with two other plausible scenarios, we think. The first, a more optimistic scenario, which is the light blue line on the chart there, is one where you do start to see some of these more virtuous feedback effects within household consumption and employment. The risk of that scenario, we think, has fallen quite significantly in recent months. Rather, we also have a more pessimistic scenario, and that's one where widespread and intense restrictions are reimposed. This is crucially not another national lockdown. Instead, this is Q2 type restrictions being applied to around 30 to 40% of the economy on an ongoing basis. And there we think that would kind of clearly significantly weigh on output in Q4 and in the first half of 2021. For now, the restrictions the government have announced broadly remain consistent with our central scenario. We expected a resurgence and associated local restrictions, but given the ongoing increase in cases, it remains plausible that we are pushed at some stage onto this, something closer to this red scenario as well. And that's something we continue to monitor quite closely. Now, turning then to Brexit, we continue to think a rudimentary deal is more likely than not, or rather a thin deal. And crucially, what we mean by this is a Canada-type free trade agreement, but we also think that's likely to come with the potential for some measures that are included in Canada not to be included in the UK deal. In particular, we think, for example, a so-called Model 4 agreement in services may not be forthcoming. That allows UK business services exporters and so on to more easily allow people to move into the EU for the purposes of selling a service. And more broadly, we also think that some of the reporting around the dispute resolution mechanism may give less security to UK firms with respect to their European market access in future. That said, the key thing here, and the key costs, as we know, with respect to Brexit, do not largely fall within the scope of a conventional free trade agreement. They're not to do with tariffs or otherwise. Instead, they're to do with so-called non-tariff barriers. And I think the key point here is whether there's a deal or not, these now seem very likely to materialize in the first half of next year. And what does that mean for the broader economy? Well, there are two key questions here. The first is, to what degree has the economy already adjusted to the post-Brexit reality, or rather how much is still to go? And then the second is, how precisely do those sort of dynamics play out, with respect to quarterly output over the coming months? Now, with respect to the first question, we continue to think a substantial amount of adjustment has still to come for the UK economy. Weak sterling in particular has generated a strong incentive to maintain capacity in the UK for the purpose of exporting into the EU, where that's remained possible. And therefore, we think much of the associated adjustment has still to come. And here again, there is some historical precedent, for example, with the example of New Zealand and the UK's trade relationship, which kind of grew more distant in 1973, most of the economic adjustment in New Zealand followed the increase in barriers rather than preceded it. But in addition, we think there are several other factors that may result in a more front-loaded adjustment from here, compounding the economic costs in early 2021. First, firms have, as we know, been dialing down investment for some time in the UK. That potentially does reflect some longer term adjustments to capacity, but at the same time, it risks kind of reducing firms' commitment to the UK, resulting in a faster adjustment. In addition, we also think levels of public and private preparedness have likely been impaired by the COVID epidemic. And that, we think, again, is likely to increase the scale of the costs at the start of 2021, with acute border disruption still a notable risk, and also is likely to compound the impact for firm operations and output. So overall, we still expect Brexit in this transition to a very thin deal to weigh on output by around 2.1% in 2021. In normal times, perfectly sufficient to push the UK economy into recession. We think a no-deal scenario would likely compound these costs with potentially around another 0.5 or percentage point impact. And now that's mainly the result of weaker sentiment, higher uncertainty, and expectations of a more acrimonious UK-EU relationship. Now, to conclude, there are two thoughts that I think are kind of important to understand. The UK is now facing two sort of once in a generation structural shocks, we think, and those we think are likely to imply, substantial reconfiguration to the UK economy in the years ahead. Now, that has two important implications. First, it implies a slower recovery initially, and a larger and more persistent increase in unemployment. It also implies a weaker level of output in the longer term, which clearly has important implications for the fiscal outlook, as Carl and Isabel, I'm sure, will discuss. Now, I think what's important is not just, this profile now feels to us relatively likely in the sense of these permanent costs. What's important is if policy, this means policy is likely to have to remain supportive for some time. And crucially, if support fails to be forthcoming, we think that could compound the economic costs, in particular via labour market scarring, which would constitute a further hit to long-term capacity, and is a strong argument, we think, for policy to remain supportive in the near term. The second thing to highlight is clearly, and as Christian described, across the globe and in the UK as well, we've seen fiscal and monetary policy work in close conjunction with one another over recent months. Now that's facilitated and made it easier for the government to extend essential fiscal support to the UK economy. But what's concerning to us is in the medium term, it's not necessarily obvious that that alignment between monetary and fiscal policy is going to be able to persist. Reconfiguration implies increases in prices as well as reductions, and there is a risk particularly to household inflation expectations that could force the bank to react, that being the Bank of England, pardon me. The second issue is to do with the more substantive issue in the longer term is the UK's dependence on foreign financing, which again not only poses inflationary risks, but could also make it more difficult for the Bank of England to provide the same kind of support to which we've grown accustomed to in recent crises in the event of a future downturn. So I will leave it there and pass over to Isabel Stockton at the IFS.
Thanks very much, Ben. So, of course, this crisis is first and foremost a public health crisis, but the consequences on the public finances are going to be with us for years and years to come. And so I'm going to take some time to present the outlook for the public finances over the medium and the longer term, and highlight some of the challenges that the Chancellor is going to be facing as we start to emerge from this crisis and beyond. So if you cast your minds back 7 months to the March budget, at this time, the government had already abandoned previous intentions to bring the deficit down to zero. Instead, the plans at the time were for borrowing to be fairly stable, around 2% of national income. And since then, of course, it's been said many times today, much has changed. In the central scenario that we analyze, which is based on Citi's central scenario for the economy, we expect borrowing to exceed 17% of national income this year, and then to fall fairly rapidly, but remain elevated relative to the budget forecast all the way until the end of the forecast. This level of 17% of national income would be the highest that the UK has ever seen in its public finance history, with the exception of the years during the 2 world wars of the 20th century. And in particular, it would, by some margin, exceed the level of just over 10% seen at the height of the financial crisis. Now, of this increase of close to £300 billion between the March forecast and our current central scenario, around 2/3, or £200 billion, is explained by specific discretionary measures introduced to support public services, households and firms through this emergency. And the remaining third, of close to £100 billion, is the direct economic impact. Mainly, this refers to lower tax revenues, as many firms are struggling. Now, it's worth highlighting that this split of 2 to 1 is really unusual. So in a normal recession, a normal cyclical recession, or even the last big recession that we saw after the financial crisis, it would be typical to have a much bigger share of the hit to borrowing to be explained by the direct economic impact, and a smaller share by discretionary measures. Of course, these two things are not independent of each other. And had the government not introduced such a large package of support, then the economic hit would have been much, much bigger. Now, what is included in this just over 200 billion package of support? Around 40% of it refers to employment and household support, most famously the furlough scheme and now the job protection scheme, but this also includes the self-employed income support scheme and the temporary boost to the welfare system. Around a quarter of the pot goes to public services, chiefly health, but also some additional money for education and transport and other public services. And another quarter is represented by business support. So mainly these are rates relief and grants to businesses. Now, in our scenario, borrowing drops down sharply next year. This is crucially driven by the assumption that, as is stated policy at this time, that all this additional spending will cease after the end of the financial year next March. Now, this is quite a conservative assumption, and there are many reasons to believe that some specific additional COVID spending will be needed, and the government will have to announce it as we go on. For example, Chapter 6 of the Green Budget discusses the outlook for public services, and it's easy to see reasons why public services might need additional funding after next March. For example, we may still need a track and trace system, which would still need to be funded. There may be also more indirect effects. For example, the NHS may need additional funding to deal with backlogs of non-COVID care that have accumulated over the course of this year. These are really important decisions with big consequences for the public finances. If just a quarter of the additional public service spending this year persisted into future years, then that would add about £20 billion to spending. There are pre-existing priorities, such as the levelling up agenda, which you could argue has become more pressing after the crisis, which also add to spending demands. And then there is the £9 billion boost to benefits introduced this year, which is currently planned to be temporary. But if the government were in fact to revert to the previous system in April, then the removal of the £20 per week boost to universal credit would mean that about 4 million families would lose an average of 13% of their benefits between March and April next year. And taking away the temporary additional generosity in housing benefits would mean that support for private sector renters would return to, rather arbitrarily, being based on rent levels in 2011. So it's quite easy to see that there could be pressure to make at least some of this spending permanent, which would further drive up the deficit after this year. Now, even putting all that to one side and just including measures that had already been confirmed for this year, then borrowing would fall, but not come all the way down to the forecast we had at the March budget, or even anywhere close to it. In fact, in our central scenario, borrowing at the end of the forecast is still just about 6% of national income. Of course, there's massive uncertainty around these numbers. For example, if we were to be fortunate and find ourselves in the more optimistic scenario with more confidence of consumers and this virtuous circle that Ben described, then this gap might be much smaller and borrowing may be below 4% of national income. And on the other side, if we are in the pessimistic scenario, borrowing could instead exceed 8% of national income. Now, just over a week ago in his conference speech, the Chancellor said that this Conservative government would always balance the books. Now, the public finances are very uncertain, never more so than now, but just looking at this, it seems like a rather safer bet would be to say that this Conservative government will never balance the books. And I should highlight that we certainly would not recommend that they try at this moment or anytime soon. All this elevated borrowing will have consequences for debt. Once again, looking back to the budget forecast from March, at the time, debt was forecast to fall slightly between this year and next, and then remain essentially stable as a share of national income. In our central scenario, there is naturally a huge jump in debt this year as the deficit is very high, after which there's a more gentle increase. And at the end of the medium-term forecast, we might find ourselves with a debt to GDP ratio of just over 110%. Once again, it matters hugely which scenario we're in. So if we're in the pessimistic scenario, debt might climb to something closer to 130%, whereas in the optimistic scenario, it might remain close to where it is now, around 100% of national income. And with all of these scenarios, it's good to keep in mind that they don't necessarily exhaust the space of all possible outcomes. Now, what does this mean when we compare it to our history? Well, if we go back to find a moment when debt was at a similar level to that we're currently projecting, we have to go back all the way to the late 1950s. So in that way, it seems rather unusual. But if we take a wider view, then it really was not so very unusual for debt to well exceed 100% of GDP over the swathe of UK history. However, it doesn't just matter where debt is, but also where it's going. At that point in the late 1950s, debt to GDP was high, but it was falling rapidly. Now, whether we can pull off a similar feat is to be doubted, but it's going to depend crucially on how much of the borrowing that persists at the end of the medium-term forecast will eventually go away and how much will continue in perpetuity. So one extreme case that we can think of is, well, what if all the additional borrowing in 2025 persists forever? So there's no more catch-up in growth and the government does not implement any other tax increases or spending cuts to compensate for these long-term consequences of the pandemic. Well, in that case, then debt would be on a permanently increasing path. At the other extreme, we might think, well, what if the pandemic is really and truly over by 2025 and we completely return to pre-virus borrowing plans with no economic scarring and no additional spending that persists in the long run? In that case, debt would be on a falling path, but it's still worth highlighting that it would take until 2040 to return to the 80% of GDP debt level that we had before the virus, and we wouldn't reach the 35% that were typical before the financial crisis until the end of this projection. Now, these are two extreme cases. It's perhaps more realistic to think, well, what if we compensated for half this additional borrowing? In that case, debt could be stabilized at a level above 100% of GDP. Now, long-term challenges have not gone away just because COVID happened. One of the most important ones for the public finances is the aging of the population, which puts pressure on pensions, health, and social care. When we use OBR estimates of these additional costs and add them to our debt projections, then even in the sort of tightest, most optimistic scenario of a full return to pre-virus borrowing plans, debt would be on an increasing path. Now, whatever the Chancellor decided to do, there are external risks. One of the most important one is interest rates. All the previous projections assumed that they remain at their current ultra-low level. But even if they were just to go back to their pre-virus level, which would still be really low by historical standards, then that could be enough to put debt on albeit a gentle, upward sloping path. And once again, the aging of the population makes the challenge of keeping debt on a sustainable path all the more difficult. So what does this mean for the Chancellor's choices? In the short term, supporting the economy should absolutely be the government's first priority. And if there are projects that would require additional borrowing but would deliver a fuller recovery, then that would almost certainly be money well spent. But in the longer term, even if our goal is only to stabilize debt above 100%, then we would need a substantial fiscal tightening at the end of the medium-term forecast in 2025 of over 40 billion in today's terms, or more than 2% of national income. This would mean that we would still be running deficits of close to 4%, so this would not be a particularly hawkish position to take. There is huge uncertainty around this figure, and it is very likely that there will be pressures for some COVID spending to continue. In the longer term, the challenge of increasing pressure on pensions, health, and social care spending will need to be addressed, and the OBR estimates that this means we need to find around 36 billion in today's terms per decade. To conclude, borrowing is expected to reach record levels for the UK outside the world wars this year, and what's more important for the long-term health of the public finances, we expect it to remain elevated for years. The economy is weak and uncertainty is huge. This means that now is not the right moment to set out the exact shape and size of any fiscal tightening. And if there are further giveaways that could ensure a fuller recovery, they would be well justified. But once we have properly emerged from the crisis, then a substantial fiscal tightening really does look unavoidable, even if we settle for a rather modest goal of stabilizing debt above 100% of GDP. This tightening will be needed not just to deal with any lingering consequences of the pandemic, but also to address long-term spending pressures from aging. And a key risk from this elevated debt, which we'll be carrying, is that interest rates rise without an associated boost to revenues from high growth. And I will now hand over to Carl, who will explore this risk further.
Thank you very much, Isabel. So I'm going to present the material that's in chapter 5 of the Green Budget, which Isabel and I wrote with David Miles. So as Isabel set out, we're going to see much higher government debt as a result of the coronavirus crisis, and it's going to be with us for many years, many decades to come. And in some sense, that's exactly the right response. When you have a temporary, adverse, huge shock to the economy, you want government to step in, government debt to rise, and then you want to try and bring it down over the longer term. So, and I think one of the first messages for the Chancellor should be to take a look at the front cover of the Hitchhiker's Guide to the Galaxy, and when thinking about this debt, not to panic. And the reason I say that is to look at the cost of servicing that debt. One of the reasons why you don't want lots of debt is you have to spend lots of tax income on servicing the debt rather than getting to spend it on things you'd rather have, such as cash transfers to households or more spending on public services. And the chart here shows the amount we spend on debt interest as a share of government revenues before the crisis hit was at its lowest level since the late 1600s, and it's now forecast to fall further. So that's quite an incredible fact. It means that despite the fact we now think we're going to borrow huge amounts of money this year, in fact, we know we are, and we're going to borrow huge amounts of money over the next few years, much more than we would have expected back in March, we think that actually the amount the government's going to spend on debt interest will be lower, not higher. And the reason for this is fairly obvious. It's because the cost of government borrowing is incredibly low. So this chart is showing the yield on government bonds. So it's the returns that investors are getting when they purchase a bond from the government, when they lend the government money, and how that varies according to whether that gilt is a 5-year, a 10-year, a 30-year, or a 50-year gilt. And you can see that these rates of interest, these rates of return have been falling since the financial crisis in 2008. And indeed, in the last 6 months, they've fallen further and are now at incredibly low, some may even say unsustainably low levels. So even if the government wants to borrow on a 30 or a 50-year basis, in nominal terms, it's consistently been able to lock in at an interest rate of below 1% per year. And the government also sells gilts which are index linked, so they're related to inflation as measured by the RPI. And here you can also see very low rates. If we take the last auction of long-dated RPI-linked gilts done at the start of September, the Debt Management Office sold £459 million worth of these gilts, locked into 2036 at a return equal to RPI plus minus 2%. So incredibly low interest rates. And this is not just a UK phenomena. The chart here is showing the average cost of government borrowing for the Eurozone, for the US, the UK, and Japan. Again, you can see across all of these economies, the return that investors were demanding from governments when they were lending governments money has been falling since the financial crisis. And indeed, the falls seen recently for the US, the UK, and the Eurozone bring those costs of borrowing back down to the levels that actually Japan has seen over the last 2 decades. It's remarkably low and in many ways remarkably scary. Japan has been able to borrow incredibly cheaply over the last 2 decades, but that's been associated with periods of very, very low growth and also many years in which inflation has turned out negative. So it's not really the fact that the debt interest costs are so low that should worry the Chancellor. It's more about why he's able to borrow so cheaply that should be of concern. So who is it that holds government debt? Who's been lending to the UK government on such low cost terms? So the chart here is showing the holders of UK debt right up to the financial crisis. And you can see 2 blocks are particularly large. One is the blue block, that's UK-based insurance companies and pension funds. They've got lots of long run liabilities. They're a natural purchaser of UK long run gilts. They want a safe long run asset to match those liabilities. The other large chunk is in light green. That's been growing over this period, and they're international investors. So they're particularly important for the UK. Indeed, they're important because you might think they're the kind of people who, if they don't like the terms they're getting from the UK, if they think the UK is not looking like a good investment, if they don't think the return is sufficiently high, they've got many other options. There's other governments they can lend money to instead if they wish. If we look at what's happened since the financial crisis, you can see that the blue bit has grown. Insurance company and pension funds have bought more gilts. You can see so foreign investors, that light green bit has grown pretty substantially in the last decade. But you can also see the emergence of the yellow block of bar. That's holdings from the Bank of England. That's a program of quantitative easing where the Bank of England is creating reserves and using the funds it's generating to purchase gilts from the markets. And that's an increasingly important part of how the UK government's debt is being held. And that has important implications for the public finances. Firstly, since March, the government's been doing lots of borrowing. That's not surprising. What people may be more surprised to hear is while the DMO has been busily selling lots of gilts to the markets, the Bank of England, through its expansion of quantitative easing, has been buying up pretty much a similar sum as what the DMO has been selling. So actually, since March, while the government's been borrowing lots of sums, it's not the case that the private sector is holding more UK gilts than it was just 6 months ago. And this changes the nature of the costs to government from financing its debts very substantially. It does it in 2 ways. Firstly, when the Bank of England creates reserves, it's charged base bank rate on those reserves that it's created, and bank rate is actually below gilt rate. It's currently at 0.1%. So that directly lowers the cost to government of financing its activities. And that's quite a sizable sum. It's reducing debt interest spending in the current year by £16 billion. And if you'd asked me in March how much it was doing, I would say it was reducing the cost by about £10 billion. So it's a big number and one that's growing. And people often point to this. But the other thing which is also very important is it reduces the maturity on government borrowing very dramatically. Because you're financing at the contemporaneous bank rate, if the bank rate were to rise, the cost of government borrowing would rise much more quickly than if you borrowed on a longer term basis through selling longer term gilts. And we now estimate that if bank rate and all short run borrowing costs rose by 1 percentage point, that would add by the year 5 about £19 billion a year to debt interest spending. That's up 75% from the £11 billion we would have said back in March. So the amount we spend on debt interest is now much more sensitive to what happens to short run borrowing costs than was in the past. That's because we're raising so much money over the next few years, and also because so much of it is being bought from the bank through its program of quantitative easing. So to conclude, what should the Chancellor be worrying about here and what should he be doing? Well, firstly, while increases in the cost of borrowing would drive up debt interest spending, it's important to remember that if that happened alongside stronger growth prospects for the UK economy, the Chancellor would also be enjoying a lot more revenue flowing into the Treasury, and that debt interest bill would almost certainly be less of a burden. While we'll be spending more on it, we'd have much more in tax revenues. So that would be a welcome scenario. Specifically, the risk we really need to worry about is the risk that the cost of government borrowing goes up, but that's not associated with stronger growth. So what can the Chancellor do to try and reduce the risk that this happens? Well, you might worry that people lending the UK government money will think that the Chancellor might be minded to do some pretty radical things, and those things could worry him. So what could he do to try and reassure them that that won't be the case? Well, firstly, he should signal that he does take the long-run health of the public finances very seriously. And secondly, he should signal that he respects the independence of the Monetary Policy Committee and that he won't engage in watering down the inflation target with the purpose of trying to help the public finances. So he won't resort to trying to induce greater inflation in an attempt to reduce the real value of debt. Secondly, I think he could change the gilt issuance strategy that the government's been pursuing. In recent years, we've been moving away from issuing long-dated index-linked gilts. I think there's a strong case for moving in the other direction and tilting issuance towards long-dated index-linked gilts. So you sell less short and medium-run gilts, you would sell more long-dated index-linked ones. And that's for two reasons. Firstly, you would lock in for a greater proportion of your debt what the real cost is going to be over the next few decades. So that would leave us less exposed to that risk that the cost of borrowing rises and it's not associated with more growth. And secondly, it would provide a more direct signal to markets that you're not going to attempt to resort to inflation to try to reduce the real value of government debt. The more you're issuing index-linked gilts, the less point there would be in trying to pursue such a strategy. So I'll now hand over to Paul, who's going to chair the Q&A session.
Well, thanks ever so much to all four of my colleagues there. That was a huge amount to chew on. There are a number of questions in Slido, but do feel free to come back with some more. I'm not sure this is a question, but I rather like the a third wave, really, oh boy. But I think that's a response probably to something that Ben said. The top question, I think it's probably quite a good one to start with, comes from Mitch Webb, has a number of people liking it. Is there a lower and upper bound on forecast UK unemployment? It asked particularly in Q4, but I think that's a more general question about what might happen to unemployment going forward. Clearly, we've had some more figures out today. Ben, I wonder whether you could just take us through some of your thoughts on what might happen to unemployment, both in the last quarter of this year, but I think going forward as well.
Yes, absolutely. Thanks, Paul. In some ways, it's quite difficult to give a precise bound on unemployment and for it to remain meaningful, because we know so much will depend on the policy response of the government, including in the pessimistic kind of scenario over the coming months. So I think it remains kind of, despite the Chancellor's comments, possible that a repeat of the national furlough scheme, for example, does come into play in the event of a very serious coronavirus resurgence. And as we've already seen in the second quarter, to a degree that can kind of essentially hold unemployment in place despite a vast reduction in working hours and associated reduction in output. That said, within the sort of scenarios we set out, and I kind of discussed, and Isabel also discussed with respect to the public finance outlook, I think for the fourth quarter, anything between sort of 7.5% at the most benign end and 11% at the most severe end is plausible. And particularly going into early 2021, I think at the worst end, that increasing to around about 12%, at the more benign end around about 8%, is also kind of reasonable in many respects. So that would be broadly where I think the plausible range is. As I say, assuming that a renewal of the national furlough scheme remains off the table. And more broadly, I think speaking to this point about reconfiguration, something we may have to get used to, I hope this is not the case, but it's definitely a risk, is that those increases in unemployment prove very persistent. We know that the low levels of unemployment we've seen in recent years have not been typical historically, and they could turn out, it could turn out to have been a very benign period for the UK labour market. And that's something we're concerned about going forward as the UK economy goes through this adjustment process.
Thank you, Ben. I can't help but ask this. I mean, what did you make of Andy Haldane's comments? I mean, you're being rather pessimistic, and he's, I think, accusing people like you and indeed us of what he calls chicken licking economics, worrying that the sky might fall in, whereas he seems to think that it won't.
Yeah, I mean, I think it's always it's definitely a dissenting view is one thing I'd say, and that's kind of always good. It means you sharpen your thinking and all the rest of it. And I think when I read that, I definitely was, I disagreed with what Andy had to say, but at the same time, I sort of took it constructively to say, okay, there's a challenge. Let's try and sharpen the way we're thinking about it and doing it. What I would say is with respect to what I understood the tone of the broader argument to be, which is this idea that economists being pessimistic then results in bad economic outcomes, is not something I generally buy into. I think the key thing, and this is always the case, is what policymakers do, both on the monetary policy side and on the fiscal side as well. So I'd be very flattered if people change their economic behaviour based on what I had to say. I won't hold my breath.
Fair point. A question which I'm going to start with Carl, but then move over to Christian to comment as well. The question is, does the level of debt matter? Isn't it the cost of servicing debt that's important? And with interest rates so low currently, I think the implication of the question is, are we not worrying unduly about the level of debt, even if it does get to 110 or 120% of national income? Carl, do you want to try that first? And then Christian, I'll come to you on that one as well.
Absolutely. And I really did mean the kind of don't panic remark at the start of my talk. I mean, we're going to have very, very high levels of debt for a long while, but for the moment, and indeed markets think for quite a while, the cost of servicing that debt is going to be very, very low. So I think what you need to think through is the risks. And clearly one risk is, well, what happens if you've got lots of debt and it's borrowed on a very short maturity basis? And what happens if the cost of that debt suddenly rises? Well, if that's happening, but you're growing very fast, that's going to be fine. You need to worry about the possibility, only a possibility, but you need to worry about the possibility that those interest rates rise, those costs of borrowing rise, and you're not getting more growth. So that's one reason to worry about having more debt. And you need to think about things you can do to reduce the chances of that scenario emerging. I think over the very long run, we also need to think about, well, we've had a financial crisis, we've had the coronavirus crisis, and in both of those situations, government debt has been pushed up substantially. That's the right response. When you have an adverse shock that's temporary, you want government debt to go up. But then over the medium and longer term, you want to manage it down. So the next time a nasty shock comes along, which hopefully will be for a very long time away, but the next time it comes about, there's plenty of room for government debt to go up again to support public services, businesses and households when that shock hits.
Yes, I mean, I obviously concur with everything that Carl said. I think you could ask the question the other way around. So the question is, does it matter to have higher debts if interest rates are low? The question you can ask the other way around: with such high debt ratios, don't interest rates have to be extremely low? And if you ask it that way around, it becomes a much more sort of dangerous question, because it effectively means that central banks are forced to keep interest rates low in order for these debt piles that governments around the world are accumulating don't spiral out of control. And as as you said, for the time being, with inflation low, that's not really a problem. But it already means that those people who hold government debt, which are funding the corona crisis response at the moment, are effectively also paying for it with extremely low returns on the debt that they're holding. And Carl showed this chart of who's holding the debt. For some, there may be no choice. They just have to hold it. But for others, there may be a choice. And they may move to economies where they get a higher return on their debt holdings. And if the UK were running a current account surplus, if it were generating enough excess savings to fund these deficits, we'd perhaps not be worried. But the UK isn't. It depends on other people's excess savings, and therefore there is a certain vulnerability, and there is a chance that interest rates will either have to go up, or there's going to have to be high inflation or the Bank of England would have to allow high inflation, which would then reduce the debt. So I think you have to ask the question the other way around, and then a train of thought starts, which leads you into pretty worrying prospects.
Great, thank you. Yes, I think as Isabel showed, the risks associated with interest rates going up are really quite significant. Certainly, if they're not accompanied by growth. Carl, there's one here which is definitely very much your specialist subject. It zoomed up the list of popular questions very quickly. Which is, what should the government do about fiscal rules? When would be a good time to set new ones? And what should the focus be? I think it's fair to say that we've seen a few fiscal rules in the last couple of decades. But what's your thinking, Carl, on whether the Chancellor should be setting out fiscal rules in a March budget, and what that might look like, either initially or in the slightly longer run?
So I don't think he should be setting out new fiscal rules come March, and the reason is that why you want a fiscal rule is you want to choose something that's going to be help communicate to people what your strategy is. It's going to constrain you appropriately when new events come along, when perhaps temptations to spend or to cut taxes come along. And I think the challenge is trying to pick a rule which now would constrain you appropriately over the next few years, and not constrain you inappropriately is pretty hard given the degree of uncertainty we face. I think any rule you picked would either be so loose it would basically be meaningless, or it would be really risky, because actually if something bad happens and if the virus lingers around for longer, if it takes longer to get a vaccine, all of a sudden you're going to want to jettison that rule pretty quickly. And I think in recent years, we've actually been getting rid of fiscal rules faster than we've actually been legislating them. So I don't think people out there are saying what we need now is some new fiscal targets. But I think what the Chancellor should do is, as I said in my talk, set out a broad strategy, which is about taking the long run health of the public finances seriously, about protecting the UK economic policy making institutions. So the independence of the OBR, for example, I didn't mention that. I think it's rather unfortunate. We have rather sizable fiscal giveaways being announced in recent months without the OBR being producing costings of those at the same time. Now, I understand it's important that policy is nimble, and maybe the Treasury needs to get some policies out pretty quickly. But actually, one of the costs of not having a budget this autumn means we don't get that chance, when the Chancellor's probably going to be announcing some new policies at some point in the next few months, for the OBR to go through those numbers and look at those costings in the same detail as it would do in a budget. So neither the summer economic update, nor the winter economic plan, nor the announcement on Friday had costings in them that the OBR had looked at that point in time.
Great, thank you. And I think that point about the economic and indeed political institutions here is absolutely vital. If the markets lose confidence in the economic institutions that we have had for so long, have been important in managing the economy, then that's going to cause real problems. So an important part of fiscal rules is not the specific rules, but the framework within which they're monitored and set. There's a very specific question here, which is right at the top of the list in terms of number of people who are interested in it, which is interesting in itself, which is about the impact of reduction in local tax collection on public service spending from next year. I don't know whether Ben Zaranko would like to say something about that and how that's been taken into account in what we've done.
Hi, Paul. Thanks. Yes, so I think the question specified is beyond March 2021. So most of the costings we have to date from the OBR relate to this financial year in progress, 2020-21, and so don't kind of project forwards what might happen to local tax collection and local tax revenue. I think it's possible that, you know, with work from some of our colleagues at the IFS have already talked about the sort of black hole in council's financing going forwards and some of the gap in funding that need to be plugged somehow. I think there was more announcements on local government funding on Friday, but that may need to be extended and taken forward into future years, particularly if there are issues around local tax collection, if people fall behind their council tax payments and so on. I don't have a figure for that. I don't think there's a figure out there, but it's certainly something that it kind of falls into the broader package of measures that we might be concerned might need to continue and be extended if the impact of the coronavirus extend beyond just this financial year in progress. But I'm sorry, I can't provide anything more specific or quantitative at this point.
Well, that's fine. I mean, if people are interested in the local government issues, we've got a number of substantial reports actually on the IFS website looking at the impact on local government finances, and certainly looking at the fact that both business rates and council tax collection is likely to be significantly down, not just this year, but over the next few years, particularly with local government bearing the cost of council tax benefit and indeed of and people not being able to pay their council tax. There's a specific question here which either Ben or Christian might want to take. It's something that's been raised on a number of occasions, which is about the inflation target. Is there any benefit or in adopting a higher inflation target of 3%, for example, or are we in a position where we're actually struggling even to get up to 2%?
I mean, I think, you know, the UK is not the first country which comes to mind when, changing the inflation target becomes an issue. Obviously, in Europe, in particular, Japan, where we're at the risk of running, well, we've had long periods of deflation or the risk of long periods of deflation. The question becomes a much more important one. And indeed, the problem is, if you declare that you want a higher inflation target, then you better have the tools to reach it as well. And I think one learning from this crisis, which also applies to the UK now, is that central banks alone are out of ammunition. They're all at the lower bounds now. And the only way for them to reach their inflation targets is by creating space for fiscal policy to deliver higher growth, closing the output gaps, and ultimately higher inflation rates. And in that sense, changing also the UK's inflation target, as such, isn't going to do a whole lot. But of course, if the Bank of England, also in the context of what I said about the previous questions, allows more higher inflation sort of temporarily in order to avoid, for instance, if there's a run on the pound, say, because of Brexit or who knows what, and that leads to devaluation in a temporary period of high inflation, that it's ensured that it doesn't react with higher interest rates to that, and then creates, in the context of very high public debt, perhaps a problem for the Treasury as well. But in a sense, the Bank of England has always been a bit more flexible, perhaps, about its inflation target, being a relatively small open economy, than the large central banks, especially the ECB and perhaps the Bank of Japan. So I don't think it's such a pressing concern for the UK. It is a much more pressing concern for the ECB or for the Bank of Japan.
On that sort of Japanese example, there's a question here about the impact of a aging population on inflation, referring to Charles Goodhart, who has been warning of higher levels of inflation, certainly since the beginning of this crisis, if not longer. What are your thoughts on the risks of inflation actually turning out to be significantly higher than currently expected, and indeed whether an aging population has a role to play in that.
And I mean, obviously, a deep book, which you know, I feel a bit overwhelmed by having to comment on. But you know, I mean, you know, in the short run, you know, there's clearly some pockets of inflation, say, where we have supply constraints and demand is relatively strong. We've had that during the lockdown, for instance, for food and entertainment products, home entertainment products. Obviously, you get some typically higher inflation, but by and large, I think in most economies, as supply goes back online, as companies open, as they produce, and demand is depressed by caution, by people fearing for their jobs, and in fact, indeed losing their jobs, as the UK labour market data showed this morning. The pressure on prices is going to be downwards for quite some time, as well as, you know, also this reconfiguration of the economy we think is going to be deflationary by and large, what Ben mentioned. In the long run, again, I mean, this problem with public debt, fiscal dominance, as we call it, so that the central banks can't raise interest rates because of the consequences that would have for the public purse. That is indeed an inflationary risk that I think a lot of people worry about. Also, that we depend on fiscal policy in order to deliver inflation, when fiscal policy obviously has far more goals than just that, makes you know, higher and more volatile inflation a distinct possibility. So I certainly wouldn't rule out higher inflation, but for the time being, we think the consequences of the crisis, the higher employment it's going to generate around the world, is going to lead to deflationary pressures for quite some time. Ben, do you want to add anything?
Yeah, I mean, I think I agree with everything kind of Christian says, completely concur. And in the near term, we are expecting more sort of disinflation into the first quarter of next year. I think in the medium term, there's probably a little bit more two-way risk in the UK than perhaps some other economies, even despite this kind of reconfiguration process and the relatively poor demand outlook as well. There are three things there that spring to mind. The first is adjustment to the kind of UK's import, external account in the aftermath of Brexit, where in recent decades, non-energy industrial goods, in particular things like TVs and so on, have consistently depressed consumer price inflation. And it is plausible that as the UK sort of unwinds its its kind of comparative advantages related to its close trading relationship with the EU, those may increase on a more persistent basis. The second is that we have seen very meaningful broad money growth in the aftermath of this kind of period of quantitative easing compared to previous ones, though I would be wary of reading too much into that. I think it's really important to recognize the deficiencies in some of those frameworks in recent decades and sort of not draw too many conclusions from it. But the key thing for me is inflation expectations, which we run a survey with YouGov, which is published monthly, and that showed a marked increase in household long-term inflation expectations, both at the onset of the pandemic and then in September as well. And we know that not all prices are equal when it comes to inflation expectations. Some are more influential than others. And we also know that reconfiguration implies some prices will go up, as Christian was describing, as well as down. And I think if you were to see a meaningful shift up in that respect, that would be something that would be very hard to look past from a monetary policy perspective, because it both implies a higher level of trend inflation thereafter, but it also implies a potential de-anchoring that forces the Bank of England to potentially react more suddenly to those temporary factors that Christian described, that the bank has hitherto been able to look past, because sure, inflation hits sort of 3% in the aftermath of Brexit, but everyone sort of knows credibly we're going to get it back to target. That changes in a world where those expectations start to move.
Thank you. We are pretty much out of time, which is a terrible shame, because we've got a list of really good questions here, including some very big ones about how the Chancellor should plug the hole in the public finances, which we could spend a long time on, but which I think I'll just give a one-sentence answer, which is that he needs to look at broad-based tax increases, the kind that are not desperately popular because they impact quite a lot of people, but there's really no other way in the medium run of doing what we think will probably need to be done with the public finances. But I'm afraid we're going to have to stop at that point because it is now 11:30. Thank you again to my colleagues Carl and Isabel, and especially to Christian and Ben from Citi, to the Nuffield Foundation and to Citi for working with us on this. Do look out for further work we'll be putting out. We are still expecting a spending review later this autumn, and we will of course be doing a lot of analysis around that. And we are expecting a budget in the spring. We have an enormous amount of really good and interesting analysis of COVID and the response to it on the IFS website, alongside, as I said earlier, released chapters of the Green Budget on things like benefit changes, spending review, levelling up, and so on. So thank you all very much for attending this webinar, and hope to see you all again, virtually at least, very soon.
Thank you.